Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
A long straddle, if you like to fade a lot of moves, and I switch it up. I go both ways. I mean, if there's markets that get choppy, I'll start fading moves. If markets kind of get firm in one direction, I'll try and go with the flow. But overall, though, it's still a nice alternative strategy. If you like fading moves and you like you're more of a range-bound trader, it really can smooth out your returns. And as a trader, as a money manager, if we're all given a choice, I think most of us would choose if you can make 1/3% a day or 1/4% a day, or if you can just get the steady grind up. It's much easier mentally to be in a job like that than to get up big, then down big, then up big, then down big. And so by blending together various strategies, and hopefully some of what we talked about today can help you do that, you're in a great situation. And if you have any questions, give me a call and or give me an email or ask Steve at the email address posted at the top here, and we'll definitely get back to you. As far as initiating goes, we talk about 2 legs at once or 1 leg at a time. Many of these can be implemented simultaneously. You can call down to your broker, and they'll give you the advice on whichever respective market you're trading, and to initiate it that way. I want to thank, just to review the presentation here, we covered the overview of options basics and background of the Greeks, common strategies and gamma trading Forex options, real-time market application, adapting your trading style and smooth out returns, and take it from there.
You did a great job in a very short period of time. And guys, for the attendees, if you feel overwhelmed, John's been doing this for years and years and years. So he obviously knows so much about options. You're not going to get this in a half hour, 45 minutes, but you can listen to the presentation again. And again, you can reach John and ask him some questions yourself. But also, at this point, we're going to actually have a Q&A, and just type the questions in, and that way we can I'll ask John as many questions as we have time for. So let me see. I think the first one I got, was from Evelyn. She said, since gamma is the rate of change in delta, why not just adjust your delta to reduce your direction exposure, John? So I guess what she's saying is, why not trade the underlier, but just trade options and then sort of sell a couple options as they become profitable. But I think you probably have a great answer for that.
Well, a couple of reasons. One, I mean, you're doing that, but two, the bid-ask spread on options tend to be wider than the underlying. And if you're long gamma and you're long the underlying, you're playing a volatility movement, and you're planning on hopefully doing a lot of trading around the underlying. If you're going to have to get in and out of the options every single time, the bid-ask spreads would destroy you, and they take away a lot of the edge that you have from doing this.
I just want to reiterate one point. Just remember that when you're trading these ISE-FX options, that there isn't an underlier, meaning that this is just an index. So back to John's point, if you wanted to trade the spot, you'd actually have to go in and trade, let's say be long, whatever. If it's US dollar or euros, you're going to be getting into a position in the spot market and then hedging it using the ISE-FX options. And remember, this is dollar relative, but you surely could do everything that John was just talking about using the ISE-FX options. And there's a couple brokers. I think John mentioned Interactive Brokers is one. I know that I'm almost positive, John, they do take the spot, right? You can have a spot account with Interactive?
Yes. Interactive is bang for the buck, the best universal account application I've seen out there. I mean, at every level, as far as opening up an account there for low, for a fairly minimal amount of money, and then you have access to the spot bond market, to spot Forex, to options, futures, stocks, all in one account platform. So it's a great way to get in there and experiment or trade. Forget experimenting, just go after it.
Yeah, I mean, we at the IAC are obviously broker neutral, but I've heard that before, so please go and check out IB if you're interested. There are other brokers out there, but definitely IB would be one choice. Catherine wants to know, could you briefly tell us again the advantages of the synthetic long short? I guess you just went through that, John. I think that you mentioned the synthetic just gives you more flexibility. so to speak, because you can trade the underlying and with the bid-ask spreads. Is that correct?
Yes, but also I'm a big internalization guy. I think that if you're gamma trading these markets or you're delta hedging in these markets, that by being able to watch the P&L and get a sense of just how the underlying is reacting, it lets me further internalize the market action, and it's more of it's a preference thing as well on top of what you just mentioned. So there's kind of twofold there, if you will.
Jim is he tends to be one of our very frequent attendees. But Jim would like to know if you can repeat your current positions and just a little bit slower. I think you said that you like gold. In fact, I think it was the straddle, but you like gold, and you thought the euro actually was going to be under some more selling pressure.
Short of straddle on the euro, 127.5. Put it on last Wednesday with the euro up near the 128-ish, 128.50, 129 handle in there. I'm trying to relate the spot to the futures and whatnot. I do. Also, in a gold strat, I'm actually slightly, the way my position is structured right now, Steve, I'm slightly bearish gold. But basically, I start off with a counter spread on gold 2 weeks ago with the way that the options expire on the respective exchange that it trades on. And I put on a counter spread. I sold the DEES calls and bought the Jan calls. And because I thought the volatility skew in that was priced way too high, and I could maybe build some back-end gamma or some back-end long exposure based on that. Well, I unwound the front month. I covered the DEESs that I was short, and then I went long the January calls, and then to turn a long call position to a straddle, I shorted half the amount. So if you remember earlier from what I talked about as far as calls and what a delta is, if you buy the at-the-money call, let's say you buy 10 contracts of the at-the-money call, and you short 5 against it, well, you've gone delta neutral at that point in time. So I went delta neutral on gold about $70 ago, $60 ago, and then exploded to the upside. Well, that obviously was a very profitable endeavor because if you're long the straddle and volatility explodes, the upside, you obviously benefit from the implied volatility, and also the intrinsic value increase as well from those calls are going to be greater than the intrinsic value loss of those puts or of the underlying that I was short. So I'm in a bit of a I've like covered 85% of my short of my short call position to kind of lock a lot of that in, but I'd actually benefit right now if gold were to pull back a little bit in that regard. But it's not the end of the world if it doesn't. And then also I'm bullish the yen as well, but more of a bull put spread, knocking it around parity right now that I put on a couple of weeks ago, so I'm kind of waiting for those to expire on Friday as well.
Just so everybody knows, if you do the inverse of the number, would you say 128? I think 1 over 128 is actually 0.78,
right,
125,
right.
Which is roughly the ISE number would be a 78 straddle. So if you were trading at the ISE, that would be the 78 straddle. Correct, John? You could just
Correct.
take the inverse. We have a question here from Catherine. What's the difference between trading delta neutral and trading delta and gamma neutral? So I think you probably went through that, but if you don't mind, just go through that again.
The delta neutral and gamma scalping, they're synonymous terms. If I go delta neutral, I'm adjusting back based on what the underlying gamma is. If the delta goes from 0.5 to 0.55, okay, well, that means my gamma just popped, my gamma on a 1% move. Well, the gamma's 0.5 on that move up. So to go back to delta neutral again or offset some of my long gamma exposure in that instance, they function the same thing. They're synonymous terms, and they're used interchangeably throughout the markets. Gamma trading or delta hedging are one and the same.
Thank you. Thanks. I think we're getting this couple of the same questions. So you, the most important thing, John, is how do you decide, as far as that gold position,
Sure.
How did you decide that you thought that the vol was cheap and you should put that trade on?
Well, the vol in the back month was cheap. The vol in the front month was not.
Right.
And I've been, again, running a commodity and currency fund just from being on top of you see situations that arise, you encompass overall dynamics, and really the rationale is several-fold. Looking across at what the currency markets are doing, which gold is basically the world's currency, in my opinion. It doesn't always act like that, but I still think that it has that value there. And then seeing what the overall equity market's doing as well. The yen at parity, if you study the volatility index and it's comparing its inverse relationship with the U.S. dollar, with the YUK ICE FX option symbol, you'll notice that the higher when the VIX index gets above 45 or 50, you really see a strong correlation between the VIX and the Japanese yen. That correlation doesn't exist so much when it's below that level. You also see a strong correlation with the yen and the S&P. And so my bull put position on the yen is more of a play that the S&P is not going to be able to rally back above 950. And again, like I said, I put that on a couple of weeks ago when the yen, the yen comes under pressure, and clearly with all the carry trade or the deleveraging that's gone on, it's a volatile it's a volatile cross that exists out there, and with all that being said, I thought there was some value from selling some put premium and hedging some of that out. So that's when the bull put spread came in on that cross right there.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.